You open Credit Karma on a Tuesday morning. Not because anything's wrong, just a quick check before work. You're expecting to see the 738 you had last month, maybe 740. You've been good. Every bill paid on time, no missed payments, no late fees. You put your work expenses on the card, earned the points, paid the whole thing off before the due date like a responsible adult. The number loads, it's 716. You stare at it, you refresh, still 716. You scroll down looking for the red flag. The missed payment, the collection account, the thing that explains it, there's nothing. Just a small gray note that says your utilization increased, you didn't spend more than usual, you paid the balance off in full, and somehow the system that's supposed to reward responsible behavior just quietly dropped your score 22 points on a Tuesday morning before you've even had coffee. This isn't a glitch. This is the system working exactly as designed, and the worst part, this isn't even the most counterintuitive way your score can fall while you're doing everything right. My name is Nick, and I've spent way too much time reverse engineering how credit scoring actually works instead of just accepting the number and moving on like a normal person. If you've ever done everything right and still watched your score fall, make sure to subscribe, because today we're going to break down every hidden trap inside your credit score that nobody bothered to explain to you. And by the end of this, you're going to be genuinely angry at a system you thought you understood. Let's get into it. Before we dive in, let me introduce you to Thomas. Thomas is 34, has a good job, no debt besides his car, and has never missed a single payment in his life. Not once. Not in 12 years. He's been building toward this moment, a mortgage pre-approval meeting scheduled for this Thursday. He pulled his score last week, expecting to walk in with something north of 740. Instead, he's looking at 711. Thomas did not miss a payment. Thomas did not open a new credit card. Thomas didn't do anything wrong in the way most people understand wrong. But he's going to find out in this video, and so are you, exactly how the system punished him anyway. And at the end, I'll tell you what that 29-point gap is going to actually cost him in dollars. Spoiler, it's a number that'll make you put your phone down. Let's start with the uncomfortable reality. Most people think credit scores work like a report card: pay on time, get an A, miss a payment, get an F. Unfortunately, that's not even close to how it works. Your FICO score is calculated across 5 categories. Payment history is 35%, amounts owed is 30%, length of credit history is 15%, credit mix is 10%. New credit is 10%. Payment history, the thing every piece of credit advice focuses on, is barely a third of the equation. The other 65% is a minefield of counterintuitive rules that punish people for financial decisions that look completely responsible from the outside. Let's go through them. The utilization trap. Nobody tells you about the number one silent killer of good credit scores is utilization. The percentage of your available credit you're currently using, it's 30% of your score, and it works in ways most people have completely wrong. Here's how most people understand it. Keep balances low, stay under 30%, you're fine. Except 30% is not a target, it's a cliff edge. People who actually carry 850 FICO scores have average utilization of just 4.1%. Below 10% is where you want to be. Cross 30% and the damage accelerates. Cross 50% and you can lose 50 to 100 points, all while paying on time every month without fail. But here's the thing that's going to make you actually angry. FICO doesn't measure what you spent. It measures what you were carrying at one specific snapshot in time. Your card issuer reports your balance to the credit bureaus once a month, almost always on your statement close date, not your payment due date. Those are different days. Your statement closes on the 20th. Your payment is due on the 15th of the following month. Whatever balance was sitting on your card on the 20th is what gets reported. If you charged $2,800 in work expenses that week, a flight, a hotel, a client dinner, that $2,800 shows up as your reported balance. Even if you paid every cent of it 4 days later, even if you never paid a single dollar of interest, to the algorithm, you look identical to someone drowning in high-interest revolving debt. The score doesn't know you paid it, it only saw the photograph. So The system that's supposed to reward responsible behavior is essentially taking a photo of your wallet at the exact moment you went grocery shopping and using that as your permanent financial character reference. Very cool, very fair. This is exactly what happened to Thomas. He used his card for a business trip to Chicago. $2,800 in expenses, all work-related, all reimbursed by his employer. His statement closed 3 days before the reimbursement hit. He paid the full balance. His reported utilization jumped from 9% to 31% for that single month. His score dropped 22 points. He did nothing wrong. The calendar just worked against him. There's also a version of this trap that doesn't require you to spend anything at all. Your card issuer can quietly lower your credit limit during a routine account review, and they don't have to tell you in advance. You have $10,000 in total available credit and you're carrying $2,000 across your cards. That's 20% utilization, perfectly healthy. Your issuer cuts one card's limit from $5,000 to $2,000. Now, your available credit is $7,000, and that same $2,000 balance is 28.6%. You didn't open your wallet, your score just went sideways. Hard inquiries, small cuts that stack up at the worst time. Every time you apply for new credit, a card, a personal loan, an auto loan, the lender pulls your credit report. That's a hard inquiry. A single one costs fewer than 5 points. Basically nothing. The problem is the pattern they create and the timing of when they hit. Apply for 2 credit cards last spring. Refinance your car over the summer. Open a store card in November. You've got 4 hard inquiries on your report. FICO treats that as a risk signal. Their own research found that consumers with 6 or more inquiries are up to 8 times more likely to declare bankruptcy. So the algorithm watches the accumulation. And here's the trap that catches people every time. Pre-approval offers, checking whether you pre-qualify is a soft pull. It does nothing to your score. The moment you formally apply for that same card you were told you were pre-approved for, a hard inquiry hits. 2 completely different things deliberately disguised as the same thing. Banks sent an estimated 2.8 billion pre-approval offers in 2024. Most people opening those envelopes have no idea there's still a cost to accepting. Closing your oldest card, a self-inflicted wound. You paid off an old credit card you never use. Maybe it has an annual fee. You feel responsible, proactive, you close it, and then your score drops 28 points. Congratulations, you just accidentally set fire to 12 years of credit history to celebrate eliminating a $3,000 debt. The algorithm appreciated the gesture, it did not reward it. Closing the card does 2 things simultaneously. It removes that card's limit from your total available credit, instantly spiking your utilization. The math: 3 cards with limits of $5,000, $10,000, and $3,000. Total available credit is $18,000. You're carrying $3,600 in balances, exactly 20% utilization. You close the $10,000 card. Now your available credit is $8,000, same $3,600 balance. Your utilization just jumped to 45%. You spent nothing. It also affects your credit history length, which is 15% of your score. FICO still counts the closed account for up to 10 years, but the credit limit disappears from your utilization math the moment you close it. You lose the financial benefit immediately and only keep the age benefit temporarily, and the oldest card in your wallet is almost always your highest limit card, which means closing it costs you in both categories at the exact same time. Keep old cards open. Put a $12 streaming subscription on them and set up autopay. If there's an annual fee, call and ask for a product change to the no-fee version. Takes 5 minutes. Score intact. The cruel paradox of paying off your loan. This one sounds like a joke. It's not. You make the final payment on your car loan. You feel genuinely great, and then a few weeks later, your score drops 15 points. The reason is credit mix. The variety of credit types on your report, which accounts for 10% of your score. FICO's internal data found that people with no active installment loans represent statistically higher default risk than people actively repaying one. So The algorithm rewards the presence of a loan, not the absence of debt. If that car loan was your only active installment account, your profile just shifted from revolving plus installment to revolving only. FICO doesn't see someone debt-free and responsible. It sees a profile that no longer demonstrates the specific behavior it's calibrated to reward. The impact is 10 to 25 points, and it's temporary. But if you're planning to apply for a mortgage 6 weeks after celebrating your last car payment, this is the kind of timing problem that costs you a better interest rate. Which brings us back to Thomas. 3 months before his pre-approval meeting, he made the final payment on his car loan, his only installment account. He felt great about it, cost him 14 points he didn't know he'd lose. Authorized users, you're financially married to their credit habits. Being added as an authorized user on someone else's card is one of the fastest ways to build credit history. You inherit the account's age, limit, and payment record overnight. When it works, it's great. When it doesn't work, you take the full damage from choices you had no part in making. You're financially married to their credit behavior. And unlike an actual marriage, there's no prenup. If they miss a payment, that late mark lands on your report and stays there for 7 years. A single 30-day late payment on a previously clean profile can drop a FICO score by 60 to 110 points. You weren't late. You might not have even known the payment was missed. The algorithm doesn't distinguish between primary holders and authorized users. You can be removed with one phone call, and the account drops off your report within 30 to 60 days. But late payments that already landed stay for the full 7 years. So if someone adds you to their account to help you build credit, just make sure the person doing you the favor isn't about to do you a very different kind of favor. Your score has 19 versions, and the good one is probably not what lenders see. There is no single credit score. FICO alone produces 19 commonly used versions across the 3 bureaus, and that's before you get to VantageScore, a completely separate model created by the bureaus themselves. Different lenders pulled different versions. Mortgage lenders currently use FICO 2, FICO 4, and FICO 5. Models so old they predate the iPhone. Credit card issuers use FICO 8. Auto lenders use FICO auto scores on a 250 to 900 scale. Not even the same range. And the score you check on Credit Karma, VantageScore 3.0. The financial equivalent of judging your job application based on your MySpace profile. Technically, a real score. Almost certainly not the one that matters for the decision you're about to make. Urban Institute research found VantageScore runs about 14 points higher than classic FICO scores on average, with bigger gaps at the lower end. Someone can see 750 on Credit Karma and show up at a mortgage meeting to find their actual mortgage FICO is 712. That 38-point gap is the difference between the best rate tier and the next one down, which on a 30-year mortgage can mean $30,000 to $40,000 in additional interest. You didn't mismanage your credit, you were just watching the wrong scoreboard. This is exactly what happened to Thomas. He'd been monitoring his Credit Karma score, which showed 738. His actual mortgage FICO was 711. He walked in thinking he'd qualify for the best rate tier. He didn't. The errors nobody told you about and the broken system for fixing them. The FTC completed a landmark study where 1,001 people reviewed their own credit reports closely. 1 in 4 found an error significant enough to potentially affect their score. Extrapolated nationally, that's roughly 40 million Americans with meaningful errors on their reports right now. Accounts that aren't theirs, balances that don't match, paid debts still listed as open collections, and the process for fixing them, not exactly designed with you in mind. When you file a dispute, your complaint gets funneled through an automated system called Oscar. Your detailed dispute, the documents, the explanation, the proof you spent 2 hours gathering gets compressed into one of 29 3-digit codes before it ever reaches a human being. Imagine writing a 4-page complaint letter with receipts attached, and by the time it lands on someone's desk, it just says code 7. That's the dispute system. A congressional investigation found the same 4 codes were used in over 90% of disputes. So the investigation often consists of the original lender looking at a 3-digit code and confirming that, yes, their data is correct without checking anything. Whereas in January 2025, the CFPB sued Experian for conducting what they literally called sham investigations. Equifax was ordered to pay a $15 million penalty the same month for systematic failures to fix known errors. These are not companies making honest mistakes. This is a system that profits when you don't know your report is wrong. Who actually benefits from your confusion? Here's the part nobody says out loud. The credit bureau business model depends on selling your data to lenders, and lenders profit more from borrowers in lower score tiers. Higher interest rates, higher fees, better margins for them. The more opaque the rules are, the more people make mistakes. The more mistakes people make, the lower their scores drift. The lower their scores, the more lenders can charge. The more lenders pay the bureaus for access to those scores. And around it goes. This isn't a conspiracy, it's just a business model. Nobody at Experian is sitting in a dark room scheming against you. The system just has no structural incentive to be easy to understand. Every dollar of interest you overpay because you closed the wrong card 3 years ago is a dollar that moved through that ecosystem. The bureaus have no reason to send you a tutorial. The confusion is, in a very literal sense, profitable. What this actually cost Thomas and what it could cost you. Let's bring it home. Thomas walked into his mortgage pre-approval meeting with a 711. He needed 740 to qualify for his lender's best rate tier. His rate came in at 7.1% instead of 6.7%. On a $380,000 loan over 30 years, that 0.4% difference is $31,200. Thomas will write $31,200 more in checks over the life of that mortgage than he would have if his score had landed where he thought it was. Thomas made every single payment on time for 12 years. He just used his credit card for a work trip at the wrong time, closed his oldest card to feel responsible, paid off his car loan 3 months too early, watched the wrong score for years, and it cost him $31,000. That is what a credit score actually is, not a report card, not a measure of your financial character. It's a game with rules that nobody explained, played on a timeline you didn't know about, scored by a version of your file you've probably never seen. And the consequences aren't limited to mortgages. It's the apartment that comes back denied because their cutoff was 720 and you were at 714. It's the car loan at 9.2% instead of 5.8% because you were in the wrong tier by 11 points. It's your insurance rate quietly going up at renewal because they pulled your credit and you didn't know they could. You did everything right. You just didn't know the rules of the game you were playing. Here's what you actually do about it. 5 specific things you can do in the next 48 hours. None of them involve closing anything, disputing anything, or doing anything dramatic. 1. Go to annualcreditreport.com and pull all 3 reports. Equifax, Experian, TransUnion, free, no strings. Look for accounts that aren't yours, balances that don't match what you owe, and paid debts still listed as open. 1 in 4 people will find something. If you do, dispute in writing with documentation, not through the online portal. A paper trail gives you legal standing that clicking a button does not. 2. Find out when your statement closes on each card, not your due date, your statement close date, then pay your balance below 10% of your limit before that date, not after, before. This is the single highest impact move most people don't know exists. 3. Do not close old cards. Put a $12 streaming subscription on them and set up autopay. If there's an annual fee, call and ask to downgrade to the no-fee version. 5 minutes. Score intact. 4. Before applying for any loan or mortgage, ask the lender which FICO version they'll pull. Then go to myfico.com and buy that specific score before you apply. The $20 it costs is nothing compared to finding out on closing day that you're in a different tier than you thought. 5. If you're an authorized user on someone else's account, honestly evaluate whether that person's financial habits could hurt you. If there's any doubt, call the issuer and have yourself removed. The account drops off your report within 60 days. Your clean history stays. None of this is complicated. All of it is invisible until someone explains it to you. The credit scoring system counts on the fact that most people never figure it out. Now you have. I'm not a financial advisor, and this isn't financial advice. These are my observations from researching how the system actually works. If you found this useful, subscribe. I do this kind of breakdown every week, and if this video just saved you from making one of these mistakes, drop it in the comments. I genuinely like hearing when this stuff actually helps someone.